Good afternoon, ladies and gentlemen. On behalf of Barclays Private Bank and PCD Club, we welcome you all to this session, Wealth Planning for Global Indian Families in the Middle East. We thank you for joining us today and for your time. My name is Yuvendra Hora, and I'm the head for Global Indian Business in the Middle East for Barclays Private Bank. And I'm joined by David Bell from PCD Club. We're joined by a panel of experts who have rich and diverse experience in various aspects of wealth planning and will share today their insights on inheritance and structures that enable multi-jurisdictional families and business to build wealth and tax efficiencies. Please allow me to briefly introduce our panelists. Bhavnita Gosrani is a director at Zedra, and she joins us from Geneva. Her vast experience with creating fiduciary structures for global Indian clients in the Middle East will help us and our audience today with understanding the key components of wealth planning. Katie Cooper is a senior wealth advisor at Barclays Private Bank in the UK. With her extensive experience of working with families in the Middle East, she will help us understand the landscape and how Barclays has been able to assist clients. I'm also pleased to introduce Sunita Singh-Dalal, who joins us from Dubai. Sunita leads the Middle East private wealth practice at Stephenson, Harwood. Her role is critical to this panel as we explore the best practices in wealth structuring in the region. Our panel is not complete without Ismael Hajjar. Ismael is the EY private leader for MENA region and an advisor to ambitious owners and CEOs of leading private family enterprises. His contribution to this discussion is extremely valuable. One of my favorite Albert Einstein quotes, which is most relevant to this discussion: intellectuals solve problems, geniuses prevent them. Do we really understand wealth planning? Does it just boil down to a will, or is there more? Wealth planning is not a one-person job. It requires a team of experts. The pandemic has brought about some sense of urgency to get it right. Well, in some cases, to get it right now. So let's get this discussion started. Katie, let's start with you. How does Barclays help global Indian families to lead and deal with their key concerns around succession planning?
Hello, everyone. That's a great question, Yuvendra. So at Barclays, we have a wealth advisory team, which I'm part of, and we work very closely as part of the relationship framework with the private bankers. Much in the same way as a client would have the private banker and the investment manager, they also have a wealth advisor attached to the client relationship. And our role is essentially to help clients where they have a succession planning need. We work with clients who have already put in place succession plans or are looking to review existing plans to make sure that they continue to be up to date, or clients who have no plan in place at all and want to use us to help brainstorm some of the key ideas and concepts before they bring in the third-party legal and tax advisors and the fiduciary service providers who can then set up the structures and run those going forward. So the wealth advisory team really helps clients to brainstorm the point at which the family are at. So, you know, most of our families have very, very successful businesses, and those businesses have generated a degree of liquidity. And it's about where that liquidity sits, making sure that they have thought about protecting that liquidity if it's offshore or if it's onshore, and also thinking about the way in which the business and perhaps their other assets can be structured to make sure that they devolve to the next generation in the right way and in the appropriate way for the family as a whole. Barclays can't provide formal legal and tax advice, but the wealth advisory team each have a background of either tax, legal or trusts, and we use that expertise to help us keep up to date with what's going on in the marketplace, and then provide the kind of key concepts and the holistic guidance that clients need to work through their succession planning structuring phase. We've got quite a good knowledge of offshore structuring, and we also have some good knowledge of onshore structuring. So we actually have an Indian trust business, and so we're able to provide that dual aspect. So looking at assets that may still be in India, whether that's business assets or financial assets, and then also being able to look at the offshore assets that may sit within Barclays or within other financial institutions, and be able to really look at the wider picture and bring that succession planning to life, covering all those multi-jurisdictions that you might be looking at. We've also got good knowledge of the UK-Indian double tax treaty, and so where clients have assets that sit within the UK, we're also able to help explain some of the concepts around inheritance tax and the planning that may need to happen in relation to that. And equally, we're also very familiar with clients who have children and grandchildren who are studying in the US or have moved to other parts of the world, such as Singapore, Dubai, Europe. And we're able to really tap into that multi-jurisdictional family and help bring the conversation together. And I think that's really where Barclays can help.
That's brilliant. Thank you, Katie. I think the way you've put it, it's really, you are the starting point for wealth planning journey of most of the clients who come to us, right?
Yes, completely. So we can't provide the formal advice, and we can't set up the ultimate structure or run that. But what we do is help clients to really start thinking about the process, and then to bring in those third-party experts and work as a team. And in some cases, we can help to project manage that. We offer this as a value-add service, so there's absolutely no cost to our clients. And ultimately, what we're hoping to do is help strengthen the assets that clients hold with banks like us, to make sure that they are protected and that they can then pass to the next generation.
Fantastic. Sunita, if I may, what are the challenges and pitfalls that you've seen global Indian families face in relation to wealth management and succession planning based on your very vast experience in the region?
Good morning. Thanks, Yuvendra, and thank you to PCD as ever. It's a great privilege to be here with all of you and share ideas that will hopefully help clients listening to this and their advisors. I think Katie started the discussion beautifully in terms of the first port of call. And I think one of the pitfalls, the most common pitfall, is actually not putting together the correct advisory team right at the very beginning. We have in India a culture whereby we have primarily probably one trusted advisor who historically has held the family relationship and has the close ear of the head of the family or the heads of the family, which is wonderful, except I think as mortals we need to understand our limitations and understand that we can't do everything ourselves. Just as, for example, I cannot advise clients in isolation without proper wealth planners such as yourselves, without trustees, people who understand the true nature of fiduciary responsibilities such as Zedra. And of course, most importantly, especially being mindful of the Indian federal budget that came out 10 days ago, without the likes of good, competent tax advisors who really understand how to interpret the legislation. What we have at the moment is also a very fast moving pace. I think the world as a whole and clients, unfortunately, have got no choice but to keep up. And by that, what's really relevant is to understand that with the team of advisors, telling clients what their options truly are. So for example, the global Indian family, we've had so many examples during the pandemic of the classic Indian family, whereby the first gen still probably sits over in India holding office, and the next gen have moved further out. But the business is a global business as such, and the outreach is indeed global, but there are implications. Some of the pitfalls we've seen are families, for example, entering into debt facilities or credit facilities to free up and create liquidity, which they need to. In times of the pandemic, clients have had to move so quickly perhaps without thinking and having had the time to consult us as to the implications of signing along a dotted line on, say, a mortgage facility or a corporate guarantee that then encumbers an asset of theirs without them realizing, which actually should be a family asset, a personal asset, maybe the family home in, say, Golf Links or Chanakya or on Nepean Sea Road. But the point is that that may be the jewel in their crown. That should be preserved and segregated from the business activities of the family. And all too often what we're seeing is people grappling around at the last minute because of liquidity or IBC type issues, and then realizing all too late that actually they hadn't had a segregated portfolio. If they had advice at the very beginning by segregating personal assets for the long-term succession and estate planning purposes of the family from business assets, that would have made a tremendous difference. That I see quite a lot happening. The other common pitfall, unfortunately, is trying to have one person do everything for you without realizing that certain assets can't be slotted into off-the-shelf traditional, for example, Channel Island trustees. There are forced ownership, there are protected ownership provisions as well for certain assets. In India, real estate and agricultural land cannot be owned by foreign entities or people who have relinquished their Indian citizenship and come back in, for example, through an indirect route as an NRI or an OCI. So it's all very tricky. Here in the Middle East, where we have an economy that is thriving and really struggling to continue to thrive, is based on Indian families. And it's really important for the families to understand that there are solutions available here to protect the portfolios in a very robust way and ring fence the local Middle Eastern assets. So times are changing. There are many more solutions. We don't expect clients to know it all, but that's where we can come in and work together as a team to kind of find a solution. It is very exciting. It need not be daunting. And there are great versatile options available for all forms of assets and types of clients.
Thank you, Sunita. There's some very interesting points you made there, and I think some of these we will come back to later. Ismael, you're a leader at EY Private for the MENA region, and you specialize in supporting families in their wealth planning journey. What is the profile of a typical global Indian family that you advise?
They would always have a connection to the MENA region, and most of the time have created their wealth through a successful entrepreneurial venture in the region. The three key jurisdictions they would typically originate from are UAE, Kuwait, and Oman, but we have also dealt with families who have made their wealth in Malaysia or Singapore, for instance, and chosen to relocate to Dubai. Some of them have created very large businesses that operate across the entire region, and some of them even became local citizens. In fact, it's quite common practice for those of you in Oman or for those of you with clients in Oman. As family business owners, their key challenges would be around succession planning, wealth preservation, and growth across generations, regulating the involvement of family members in the business, preserving harmony and unity in the family, regulating who can sell shares in the business. Professionalizing the business is also generally on their mind, as the wealth was created over a short period of time, and it was really never a top priority on their agenda. But they also face unique challenges being non-GCC nationals doing business in a region, connected, for instance, to the requirements to have a local partner, having most of their wealth in a high geopolitical risk region, and sometimes facing laws that are based on a faith that differs from theirs. And there, of course, I mean Sharia. That is particularly true from a family and inheritance laws perspective, where we see Sharia having the most impact.
Thank you, Ismael. Before we move on to Bhavnita, could you give us an example?
Sure. Over the past 18 months, we have, for instance, supported a well-known NRI family who owns a large business in the UAE with the professionalization of their global wealth ownership and governance ecosystem. As Sunita mentioned, it's teamwork. So we would work with the bankers, we would work with the lawyers, and we would play a leading role in that transformation and professionalization project. We started the project with them by creating 3 maps. And this is our usual methodology: the map of the wealth, the map of the family, and the map of the objectives. The map of the wealth is there for us to understand what asset classes exist, in which jurisdiction they're located, and how they're currently owned by the family. The map of the family is for us to understand family dynamics, who is who, but also the more tax relevant information, such as what are the passports of the relevant individuals and where do they maintain their personal tax residence. And of course, for those of them who have a connection with the UK, what are their domicile from a legal perspective. The map of the objectives is of course something that is personal to the family, but we see a lot of families not really knowing what they want. And therefore, it's often in collaboration with us that we help them shape up their list of objectives. So based on that data, so the map of the wealth, the map of the family, and the map of the objectives, we established a diagnostic and proposed several ownership and governance models to meet the family objectives. The model selected by the family consisted of the full segregation between the regional and the international assets owned by the family, which is not uncommon because of the instability from a geopolitical perspective of the region. The selected model involved the creation of a family trust in Singapore on the international side, managed by a Singapore private trust company, while the regional assets were consolidated through an ADGM holding company owned by an ADGM private foundation. Some assets could not be transferred to any of those structures and were left in the hands of individuals or SPV, with wills being created in the jurisdictions where the assets were based. The entire structure was governed in accordance with a comprehensive family charter that was made legally enforceable, thanks to the help of lawyers, through its integration to the constitutional and contractual documentation of the structure.
That's brilliant. Bhavnita, thank you for joining us from Geneva. What have you seen happening in this pandemic period amongst the global Indian clients in the Middle East? And have you seen any sort of changes in their behavior toward wealth planning, especially?
The pandemic has taken its toll on everyone, but at the same time, it's really given people the opportunity to reassess their lives, look at their businesses. The fact that we can't fly anywhere, restricted mobility being a reality of our lives at the moment, it's given people the time to pause, to really reflect and review not only existing structures or plans that they put in place, but also make new plans potentially. Many clients have come to the realization that they shouldn't wait until there's a big life event to make some decisions. It's too late. And many of our Indian clients know family members or other people they know who have been impacted by COVID. And it's just brought home the reality that we really need to think about this before it's too late. Wealth planning, succession planning. Now, for me, on a day-to-day basis, what have I seen? I've had settlors come to me and say, "Can I just see that letter of wishes again, please? Do you really understand what I mean?" It's very, often a letter of wishes is drafted, we put it in the file. Do we as trustees really understand what the message they're trying to convey? And you've had several settlors really review them. We've had settlors say, "Please, can you start involving my children in the trust operations in terms of educating them? What is a trust? What are the investments of the trust?" Where we've got trusts that own shares in family businesses, there have been liquidity issues with requests. We've received requests to consider distributions. Obviously, we need to have the full information for us to consider that. We've got a mutual client together where The daughter went off to the US a couple of years ago to study. She then started a startup there. She was very happy. But look, with the pandemic, she's decided to come back to, to Dubai, and the plans are all open. Will she ever go back to the US? Is that structure still suitable? Maybe she'll move to India to look after the family business there. And that's where we need to get, people like Sunita involved, people like Ismael involved to really review the structure and see, is it really appropriate? The other point I'd make is communication has become, even more important. Throughout the pandemic, we've had to keep our clients informed about the performance of investments, where we've got commercial property in the UK. And this sector is found it really difficult. People just work from home. Oh, do we really need that office? Well, what about the income we were getting from the trust? That's not going to be there anymore. We can't make those distributions, but we can't just come out with that decision 9 months after we've decided. So, and it's two ways. If we hold shares in a family business, we need to know how that business is performing. We've got a duty. So communication is more and more important in periods like this.
That's fantastic. Katie, talking about liquidity, can you tell us how liquidity planning has a role to play in succession planning?
Yes, of course. So when we're talking with clients about their succession plan, one of the key points that we talk about is whether or not there is enough liquidity for the family to continue having the lifestyle that they currently live after the main family member has passed away. And this is where liquidity really comes into play, because many of our multi-jurisdictional families have assets in countries where there are estate tax duties, like the UK with inheritance tax, or the US. There are also businesses that have a large amount of debt or other assets which have debt or mortgages. So for example, families that have large UK residential property portfolios tend to have quite a high level of debt or mortgages against those, primarily to help with the inheritance tax benefits that you can get from that, but also just from a liquidity perspective for the family. There are also families where there might be one or two key individuals who are bringing in the majority of the income. And if suddenly, they were to disappear, they would be leaving some very young family members, and there might not be sufficient liquidity within the family to continue their lifestyle without having to sell down some of the other assets that they hold. You've also got businesses that are run by one or two key individuals, and if they were to pass away, then those businesses would lose a lot of the expertise and the knowledge, which means that the business as a whole may struggle to continue, or the market may view that business as a struggling business going forward, and that can have a real detrimental impact. Where liquidity can actually help step in to bolster the business until the new family members or the new board are able to really show and demonstrate that actually they can control this business and move it forward for the new generation. There's also benefits with liquidity planning for estate equalisation. So where we do have assets that are based in the UAE and are subject to Sharia rules, often those assets have to go in certain percentages to certain individual family members. And that may be something that a global Indian family is not necessarily familiar with, and where they have a high level of assets in that jurisdiction, they may not be able to balance out their assets so that other members of the family, particularly the female line, are able to benefit equally, and there'll be parity across the next generation. So liquidity planning can really help there, because if you generate a pool of liquidity that pays out after lifetime, those assets can be ring-fenced for the family members that aren't able to benefit because of forced heirship rules and Sharia from other assets. So where parity is key, that can really help families achieve that. So those are probably the key areas where we see liquidity planning help, and where we see insurance providers find that there is an insurable need that they are able to provide a policy to assist with. From a Barclays perspective, we're unable to provide, for regulatory reasons, we do not provide the formal advice on insurance products. But what we do is we work with a third-party panel, and we have a number of very, very good insurance brokers that we refer our clients to. They're then able to go out to the market as a whole and source the most appropriate product for that family in particular. And the other key point about liquidity planning is that it slots in very nicely with the wider succession plan. And that's mainly because it can sit within a trust. So when the liquidity pays out, the funds, rather than going to individual family members, can fall into a trust that the policy has already sat within. And then that provides some structure. I think Sunita may have a question that she wants to address.
Sunita.
Thanks, Katie. Sorry, kind of deviating a bit, but just wanted to pick up for the benefit of the audience, something that you mentioned earlier on in terms of liquidity for Indian families with assets here and Sharia. And that exactly highlights the points that we were making earlier on, which is working together as a team to give them the right, to give the families the right information in terms of what's now available. So yes, indeed, before, families who've been firmly entrenched here for many, many decades, perhaps some as early as the 70s, would have had Sharia as a point in the forefront of their minds in terms of protecting their asset portfolio here. Now, thankfully, thanks to trust laws that we have in place, family contract laws that we have in place, and more importantly, 3 different foundation regimes, without boring you with the legalities, these are all tools that can be used to actually protect assets from any form of Sharia applying, provided proper planning and protective measures have been taken place during the lifetime. Because of course, what's really important for clients to understand is Sharia law will apply upon death in relation to anything that you own at the time of your death. So therefore, in accordance also with the Hadith, if one has actually made provisions during your lifetime to protect your loved ones for years to come after you have passed away, and you have therefore made a lifetime settlement, a distribution, you've engaged the entire family in this planning process, and everybody has signed up to this, then actually the kind of, the concepts in terms of Sharia law need not actually apply, because you no longer own those assets. You have already divided them and shared them amongst the next generations to come, or kept provisions aside that are time kind of limited. So you've got hurdles, which we'll come to discuss later in terms of protective measures of vulnerability of children. But I just wanted to intervene there because that's exactly one of the messages that clients really need to understand, that there are now changes and the concepts and misconceptions that were there before no longer actually apply.
Thank you, Sunita. And Katie, thank you very much. Look, 2 key points from this discussion that we've had. I think estate equalization is definitely something that is in the minds of many of our Indian clients. A lot of them I deal with. They often wonder if there's the involvement of the older child in the business and the lack of involvement of the other kids and the other siblings. So they really want to make sure that the legacy they leave behind is effectively fair, which I think is a very important point that you bring up. And of course, the application of Sharia law, which Sunita mentioned about, I think it's quite critical that this discussion, especially for the Middle Eastern clients, is something that we have way in advance before things structured. Sunita, picking up on that, protecting wealth in the Middle East is one aspect of advising families. How do we help them safeguard and protect their children, especially in the current times of vulnerability and uncertainty?
Thanks, Yuvendra. And I think you and I have discussed this previously. And for me, first and foremost, it really saddens me sometimes when families forget that actually their true wealth is their children. It's not the material assets that are locked away in banks or being protected on the stock exchange or with operational assets. First and foremost, a lot of the business families are still parents to children under the age of 21. And because a lot of the dynamic of the family is such that we don't have an extended family support system in place here in the UAE, it's vital that parents understand that there is a mechanism where you should be responsible parents and have guardianship orders put in place for your children in the very sad inevitability that something happens to us as parents and our children are left here all alone. And there are some very simple measures that we can advise and help clients put in place that don't take long at all. And that's just having particularly named interim guardians appointed by the DIFC courts, who will have jurisdiction and will be able to take custody of the children and just look after them until perhaps a permanent member of the family, a grandparent or an aunt or uncle, flies in. Those kinds of measures are very quick, but really essential. And it really saddens me when I see that parents do not think of their children as paramount first and foremost. That can be done, but then in addition to that, and that of course is only in relation to minors, how do we protect our children in such times? Again, working with trustees, working with yourselves to ensure that perhaps, for example, we've got provisions that are there, that again, if something happens to us, we are empowering and entitling our children so their educational journey is not interrupted. So we can earmark funds and put them inside. Or as Bhavnita was saying, the young lady in the US, there was a fund that was set aside to help her start up a business venture. Okay, at the moment, it's kind of come to hopefully a temporary halt because of the pandemic, but she'll start up. So again, empowering our children and allowing the next generation to actually grow and diverse our portfolio is also very, very important. Why? Because in the region, families are now educating their children to a larger extent and a longer extent than they did before. Children are now understanding, for example, the importance of ESG type impact investing. Children are understanding the importance of diversifying into other geographies. If as parents, we don't allow our children the liberty to make those judgment calls and make mistakes and learn from those mistakes, then what is the point of succession, as opposed to just forcing the children to continue in the family business, which sometimes they really don't want to. And that can be far more detrimental, because if a child is forced or imposed into a position of authority, they can do more harm than good. And you may find that 3 generations worth of wealth is dissipated with a very, with a few bad judgment calls. So there are lots of things that we can do to empower the next gen, but provided as a family, we all work together with the right advisory team. Vulnerability is something that we can definitely help protect against.
Thank you for that, Sunita. Bhavnita, what can make wealth planning so difficult?
Good question, again.
Difficult question.
What makes it so difficult is that there is not one size that fits all, basically. You've got individuals, global Indian families, family members resident in different locations. You've got a variety of assets. So you can have real estate in the US, UK, India, financial assets. You'll have business interests in Kenya, Nigeria, Kuwait. I mean, you need the right advisors in those jurisdictions to potentially advise on the best solution or solutions, depending on what the client's aims are. Now, I was speaking to Sunita yesterday and I asked her, well, what do you think? And she said, well, typically the biggest mistake that Indian clients make is they have one advisor, they want to save a bit of money, one advisor does all the work, and that can be disastrous. So you need to get tax and legal advisors from the right jurisdictions involved, and simultaneously fiduciaries, and they all need to work together to find the most optimal solution or solutions. It's not, I'm not saying the trust structure is right for all those assets. We take a step back and we think about a typical global Indian family. The founder might be based in Dubai. He's got a brother in Kenya running the business there, the nephew in Nigeria, another family member elsewhere in Kuwait, for example. Well, they've built up a large amount of wealth, but there's a lot of underlying problems here. generalizing, but let's have a think. Actually, the older generation doesn't want to let go. 75 still running the business. The next generation has not been properly trained, not really interested. Their children have got no interest in taking up this business. You've got communication issues, and typically just put the problems under the carpet. Let's not talk about them. Let's not really communicate. And again, another generalization, but there's often a lack of rules. So conflicts will then arise. With such families, there's a fine divide between family life and commercial life. It's kind of all blended together. And more we see such clients appreciate the value and the need for wealth planning and putting structures or solutions in place to mitigate problems in the future. And that's where we'd get, business interests are not always suitable for holding a trust, and we'd get, Ismael and Sunita involved to discuss with them family governance or shareholders agreements that might be suitable to put in place in such scenarios to create more clarity between family shareholders. Ultimately, it comes down to people realizing that they might die and that they should think about planning for their wealth from a succession perspective and many other respects before it's too late, with the right advisors from the right jurisdictions. And also, I think Ismael, I've seen another PCD event where he said, that the laws in the GCC change continuously. You need to be aware of that and keep, being willing to look at the plans you put in place and where they need amending.
Well, thank you. Ismael, a number of Indian families have created large businesses and accumulated considerable assets in the Middle East. What are the best practices to preserve their regional wealth?
Well, clearly, the leading practice is to act proactively and create a strategy to deal with wealth preservation. Having good advisors, as mentioned by a number of you today, is essential, as the landscape has been significantly evolving in the past 3 years in the region. So there are great tools available to families, and those tools have now been tried and tested. But families are not necessarily aware, and some advisors are not necessarily aware or not necessarily applying them, or using them. So it's very important to have the right advisory team. And as some of you mentioned already, what families need is multidisciplinary teams. So with the right people, but the right people with the right skills complementing each other. So most of the regional wealth here consists generally on businesses and real estate. Both can be moved out of personal names and transferred to private foundations, for instance, or sophisticated holding companies governed by common law that are considered as GCC companies. I think that's certainly a trend that we see. Dealing with the local partner risk early on is also extremely important. There are a number of structuring arrangements available to mitigate that risk, and it could even be that the business activity can now be owned 100% by foreigners, so maybe 100% by an NRI non-GCC family. It's really very important, and the worst case scenario is always to have a passive local partner owning 51% of your business in his personal name, as his legal heirs would own your business upon his death, which can lead to a number of issues, as you can imagine.
Considering the legal landscape is ever changing, and you and EY would have more visibility of this, from an academic perspective, did you observe any sort of major changes in the last sort of 18 to 24 months in this respect?
Look, clearly there is more and more appetite to use some of the recently enacted wealth preservation solutions made available across the various financial centers in the UAE, right? And with, I would say, probably as far as my client base is concerned, a focus on ADGM, so Abu Dhabi Global Market, and DIFC, Dubai International Financial Center. So in particular, and that was mentioned already several times, although it's not the purpose of this webinar to really get to the bottom of it and go through it in detail, but in particular the private foundation regime, which is essentially a civil law equivalent of a trust, just to put it very, very simply, has been a big success given its acceptance by the local registration authorities, be it the local registration authorities in charge of businesses, like the DED, for instance, in Dubai, or the registration authorities in charge of land and properties, like the DLD, Dubai Land Department in Dubai. And frankly, I think there is more to come when it comes to the success of foundation in the region. I also mentioned, due to COVID-19, we'll see more appetite to plan for the worst, right? Sometimes for good reason, sometimes for bad reason, or let's say sad reason, and planning for the worst often then kicks off family governance projects, particularly when there is a business and when the younger generation reaches the age of potentially joining it.
Fantastic. Sunita, if I may ask you this very important question, does a will provide clients with effective solutions for estate and succession planning purposes? Is it really that simple?
No. In a
That's
nutshell,
a simple answer.
And no, I kind of sometimes hold my head in despair, and the sometimes comes about depending on what the assets are that the client actually owns and wants to protect, and for the benefit of whom. A will, if nothing else, gives you a certain, well, it gives you a full sense of certainty whilst you're alive, because once you've popped it, you have no idea if people are going to honor your will or they're going to contest it. And that's really important. But apart from that, recent examples, I was approached by somebody recently who wanted to protect a portfolio of thoroughbred horses and in the region, which is it's quite a significant asset, different to say the least. And the gentleman came to me from his advisor saying, I've been told that the thing I need to do is have a will in place. And I said, okay, so what do you want to protect? And we talked about this, and then I understood what the chap's occupation was. And I said, that's great. The will only come into operation for the benefit of your wife and children once you've passed away. What do we do in the event that, God forbid, you're out on the racing track or out in the desert and you have an accident and you break your neck, but you're not dead? However, your operational business, your equestrian business, has come to a standstill. Can't be operated because there are no operational provisions or next attorneys or other directors that you've empowered to take decisions in incapacity. So the long and short is, a will probably works really well if you're ordinary people like myself, who've got a husband, a couple of kids, and maybe one or two assets. Okay, so for the vanilla employed kind of salaried people, expat population living here, it does give you some protection. It really does. But for people who have got vast portfolios of operational assets, it doesn't work, because you've got to go through a lengthy probate process. That too, if it's not contested by some disgruntled family members. And that, of course, entails fees. What people often think is a will is a cheap and cheerful solution. It may be, but whatever's cheap will certainly cost you in the long run. And therefore, because of the fantastic options that we now have available in the UAE, for example, private foundations, that are not necessarily cost prohibitive or that much more expensive, but those give you long-term, in perpetuity, for at least 100 years, solutions for ownership of your family wealth, regardless of people passing away and leaving the family, or regardless of people joining the family through births and marriages. So to my mind, it really depends. There's no clear-cut answer, but the kind of clients that all of us on this discussion today advise, the ultra high net worths and the high net worth clients, a will is not the ideal solution. You can have a hybrid of things. I think Ismael mentioned in his example earlier on, there were a few assets that weren't capable of being protected in terms of certain structures. For those, we can at least ring fence those, but those should be the smaller minority portfolio as opposed to the maximum. So you have to work across and take a holistic approach, frankly.
So I know that this discussion can go on for hours. We'll just go ahead with one last question, and then we're going to go into Q&A for our audience. So Katie, during this pandemic, we've seen a behavioral change in many of our client behavior, the way they have started to look at things in depth. Have you noticed in the last 12 months any rise in sort of them seeking insurance solutions?
Yes, I think the simple answer is definitely yes. You know, we've spoken about the you know, the laws and the regulations and the world moving at a very, very fast pace, and that's true outside of the home. But inside the home, most people have been through a number of lockdowns or, you know, faced various restrictions where they haven't been able to go out and mix as normal. And during that period of time, they have been at home with their immediate family members who live in the same property as them. And it has really brought home, I think, to individuals the importance of family and the importance of making sure that they are protected. And as Sunita said, you know, the vulnerable and the young, you know, the right structures are put in place to benefit them, but also the liquidity is put in place to make sure that they can, you know, just carry on if something were to happen to a key family member. You know, it's all very well having wills, but they have to go through probate. And if you have a trust structure, you know, ultimately there are trustees at the end of the day that you have to speak with in order to get hold of assets. I have come across you know, a particular example where I have an individual who is an NRI. He has a very, very wealthy family, but he has taken a step out on his own, and he is a managing partner of a firm now in Dubai. And although he has that background of wealth, he has decided that he wants to put in place something which is solely to protect his immediate family. So not having to tap on the wider family resources, but making sure that if he was, you know, something to happen to him. And unfortunately, in this case, he has had a colleague who, quite young, who has passed away due to the pandemic. So suffered from COVID, and obviously the family and the friends are in a grieving period. It has brought home the mortality to my client, and he has then thought about, well, I have two very young children. I have a wife who isn't familiar with the business that I'm involved in, and her main focus at the moment are the two children. So we've spoken to him at length about what can he do to provide the liquidity, because if his income disappears, it would be the wider family they would have to tap into, and putting in place an insurance policy. So in this case, he's considering universal life. He's able to use the income that he has at the moment, and the insurance providers are looking at that and taking a 10 to 15 times multiple of his annual income and saying, well, let's look at putting a policy in place that will pay out after lifetime. And he can put that into a trust or a master trust that might be provided by the insurance providers, which means that he knows it's secure and it will pay out to the trust, and then they have a letter of wishes where they will pay it for the purposes of the young children going forward. We're also finding that the insurance providers we're working with are becoming much more flexible in terms of what they are able to achieve due to the pandemic. So it used to be the case that clients would have to fly into certain jurisdictions in order to have their medicals. They would have to sign documents for insurance policies in various different jurisdictions. The providers have become much more flexible and have realised that individuals can't move from jurisdiction to jurisdiction as easily. You can't just board a plane and go to Singapore for the day. It doesn't work like that anymore. So what they are doing is they are making sure that they are vetting hospitals and clinics that are in the local area. They're arranging for medicals to take place you know, on a much more flexible basis. In some cases, we're even seeing some providers who offer small policies without having a full medical, and instead being able to do a shortened version of a medical by telephone. And that's really, really helping clients who want to put a small amount of liquidity in place immediately to have that. And then once the world opens up, they can then go and take the full medical and then extend the policy if that's what they're looking to do. But it really is, I think, the pandemic focusing people's mind on their immediate family members and making sure they have the funds to continue in the lifestyle. And where they are, having businesses where they've had to take out a lot more debt and lending in this period of time to keep the business flowing and working as normal, ultimately at the end of the day, somebody's going to have to pay for that debt. And having a liquidity plan, which will then repay that if you pass away, just puts the books back at a balanced position, really. And I think it's definitely a sensible part of any succession plan is to think about liquidity.
I would love to ask and keep asking questions because I'm getting free advice here. But I think we must open this now to our audience to ask some questions.